Good day, fellow investors. As you probably know, I made a few videos over time, and this leads to a lot of confusion. Because I get comments like these: Dominic, Sven, do you suggest we sell 60 to 70% and stay in cash? Or Mark, wondering whether this time is different, whether the market will not crash, depending on where the videos are coming. And yes, if you look at the videos, so if a recession happens, the market will go 40% lower. However, then I say if something goes lower, it's a better buy. So we are already lower. Barry says much lower. Then we discuss 15 businesses because Buffett is buying hugely, 50 billion spent. The risk and reward on Facebook is very positive, for example, but I don't own it. So what is going on and how to make sense of this? And that's why I want to discuss this thing that I written down to really show what am I really thinking about the market and what really matters when it comes to investing, and I hope this will help you a lot. So let's start with the summary of my investment thesis step by step to explain and to give more context to all those videos. So this is what I want to explain, and let's start with YouTube videos. The purpose of YouTube videos is to share ideas and to explain those ideas so that you best find your answer to your financial situation. We are all different. My job here on YouTube is to educate and explain the risk and reward. A recession can happen, the market can crash 50%, that can happen. The market can go up higher if the Fed decides to trim down on rate hikes to stimulate the economy, to let inflation run rampant even higher. The market will follow and go higher and higher. That is something that can happen. And that's the ideas that I like sharing. Just a comment, of course, if there is a recession or something like a crash in the title, those are always the best viewed videos. So if I want to make a video for fun, then always using this will lead to the highest views. That's YouTube. But the goal of these videos is so that you can be prepared for everything or anything that will happen. Unfortunately, my crystal ball broke and I can't see the future. Thus, I have no idea what will happen in the future. I can just be prepared for anything. Because, as Ray Dalio recently said, if you are prepared and you know what can happen, you won't be sorry when it happens because you know what will happen and prepared. If you don't think anything can happen, then you are in trouble when something happens. And the outlook is here that it is impossible to predict the Fed, whatever. It's good to know the possible outcomes and then invest in a way that everything is good. Why it is impossible to predict? Well, just go back 5 years. And as I'm filming this is a 5-year anniversary of my first video, so 26th of May 2017. Thank you all for the support. But in 2017 already the Fed told us to sell stocks because they said they will increase interest rates, they will hike rates, stocks will go down. Do you remember 2017? And then they started increasing interest rates, but already in 2017 the market was 15% up. Then as interest rates started going up till September, the market was flat, even down, and then really down. Then again, flattish on higher rates. And then it started booming in September 2019. Why? Because it was clear that the Fed cannot raise rates anymore. They had to intervene in the repo markets, push liquidity into the market to save the market from collapsing. And then it was clear, okay, the Fed can't hike more, and then stocks went up. Then okay, crisis, but then even more printing up and up, and now we are down expecting more hikes. But whether this will be up or down, nobody knows. Trust me, nobody knows. And funny here, 5 years, you should own gold stocks. Okay, gold is up, so miners also did well. So that is the way to hedge your portfolio. I think I'm smarter than back then, but okay. This was a funny note here. So the message is impossible to predict, nobody knows, and I just explained the scenario so that you can be ready for anything. That's the first message. And then discussing scenarios. If we look at the risks for the developed world, those are crazy. High debt levels, bubble of everything, 40 years bull market is behind us, low productivity, nobody wants to work, everyone is looking for employees, bad demographics, high valuations, needs debt monetization and currency sacrification for surviving as it is. So this is really a bad outlook, so one has to be careful when it comes to investing. And again, this is confirmed if we look at Grantham's outlook for returns for 7 years from now. Those are extremely negative for US equities. And then the positive is that emerging markets are much cheaper. Grantham says the only ones, especially value, they're offering positive returns over the next 7 years. And if we look at international valuation and dividend yields, you can see that from a historical perspective, emerging markets are much cheaper now than US markets, and also from a price to earnings discount, the discount is 2 standard deviations from averages. But that's just emerging markets. There are always pockets of cheapness in developed markets. 2020 October, oil stocks were extremely cheap. So there is always something that is cheap and something that you can find for your portfolio. And that's the key of whatever I do. There are markets, anything can happen, blah, blah, blah. And there are businesses. Value investing, bottom up. We look at businesses that will do good no matter what happens in the markets. Okay, if it's great, you make 10x. If it's not great over 5 years, you likely make 2x. Still good. That's investing. And that leads to the strategy of investing into the best businesses we can find at the best price. Accumulate more if those prices go lower, but the business is still doing good and compounding value, earnings potential in the future. That is investing, and that should be my message everywhere. But I try also to discuss all these topics, and if you follow me for longer, it always ends up in the same message. The risk, yes, blah, 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 but at the end, buy businesses, buy value, be a value investor. And that's the only thing that works forever, time and time and time. There is not risk, and that's how you accumulate wealth over time. That's it, my friends. I can't do more. So this is the template. You can pause it. If there is a designer who wants to make this nice and so that I can use it and develop it and grow it in every YouTube video, I would really appreciate that. You can send me an email with investwithsven@gmail.com. My only email. Sorry for the scammers. There are many scammers out there. Don't trust anyone. So this is my email. You can send there ideas or designs if you want to have some fun, of course, for supporting the channel. So let's go further on deeper asset class expectations and investments. I really think that stocks for good businesses are best. Index funds is okay for dollar cost averaging, as we did in a video last week, but not really great. Average returns if correct strategy. So unlikely, because 50% of you will divorce, so you won't be able to have the right strategy all the time. Bonds are terrible. We have seen negative returns. Gold doesn't produce anything, so it's a gamble. And of course, Ray Dalio says yes to a portfolio, depending on how much diversification you want, but it is, as we have seen in the video discussing hedges, not that effective. I'll put all the links to the videos I mentioned in the description below, or you can search on my channel. And the message is that you can find good investment everywhere, even in gold miners always, but it also depends on the price you're paying and what your goals are. Those are the keys. Let's go to strategy. The first point, I always think it's not necessary to emphasize, but is saving. Investing starts with saving. If you save, you can invest. Then long-term view, where will this be in 5 to 10 years, plus long-term flexibility of investing options. So you are flexible to switch between assets across anything in order to lower your risk and maximize your returns. Markets are irrational. That is always an opportunity. And buy value, focus on risk. What can I lose? And the rest will take care of itself. If something goes down and is still good, simply buy more. And Miska Simula here explained everything. Biggest problem at Adobe is that everyone already knows it's a great company. If discounting terrific things are already in the stock, I don't want to own it, Peter Lynch. And of course, the second part of his message: when you are making an investment decision, first focus on how much money you can lose, and then look at how much you can make. This basically means that managing downside risk is equally, if not more important than return. This is Seth Klarman's message: manage your risks. And that's why I do the video, so that you can learn about investing, about the risk and reward, manage your risks, and create a vehicle for yourself for wealth accumulation that will work over time, over your lifetime. Not the crazy short term, but over the long term, so that you can be sure of creating and accumulating wealth over time. That's the essence of investing, and I hope I am helping you on that path. Thanks for watching, smash that like button, and I'll see you in the next video.